Tens of millions earned, yet mathematically suffocating under heavy concrete. The public looks at global box office dominance and sees infinite money. They associate this operator with the gross receipts of major intellectual property franchises. But the mechanical reality of this wealth engine is brutal. If the target secures a $20 million gross payout, systemic friction consumes a staggering $12 million. This happens before a single dollar reaches their operating accounts. They trade their time, physical presence, and brand equity for large base salaries. But active income ceases the moment the individual stops performing. Let us trace the true net worth illusion of this specific entertainment operator. High box office revenue looks like pure liquid wealth to the average viewer. It is absolutely not. 20% of the gross influx is structurally eliminated immediately. This cash is burned simply to maintain the required professional representation apparatus. 10% goes straight to the primary talent agency. Another 10% is split evenly between the business management firm and the entertainment law firm negotiating the complex franchise contracts. Add peak California and federal taxes, and active income becomes a highly inefficient wealth vehicle. To pivot away from pure active labor, a corporate entity named Indivisible Productions was formed. From a strict financial perspective, the critical mechanism is the corporate structure itself. It operates under a universal first look agreement. The parent studio provides the capital to cover daily running costs. This includes office space and executive staff salaries. But this arrangement fundamentally caps true corporate operating leverage. The parent studio keeps the absolute green light authority on all projects. Crucially, they capture the vast majority of the back-end profit participation. The production company acts as a risk-free incubation chamber, but the talent remains a highly subsidized tenant inside the major studio system. If corporate overhead is completely covered by a parent studio, what specific mechanical failure is actively destroying the entity's personal liquid wealth? Severe capital leakage happens when wealth gets tied up in hard assets that cannot be quickly converted into cash. The target operates under a dangerous system called the concrete anchor. They bypass standard commercial loans. They sink their net liquid cash directly into unyielding luxury real estate. The crisis starts with a hyper-customized 13,000 square foot compound. They bought raw dirt in Pacific Palisades for $15,600,000. They rejected the standing architecture entirely. They spent 3 years building a massive new structure. They built it to exact, highly idiosyncratic specifications. Then they attempted to exit the asset. They listed the custom estate for $32 million. The open market violently rejected that specific valuation. Buyers in that elite price range want their own vision. Despite eliminating over $12 million from the original asking price, the market aggressively rejected the asset a second time. The listing was eventually pulled completely from public view. This 8-figure luxury asset generates absolute zero yield. It consumes massive unrecoverable carrying costs. Every single month, it remains unsold. Unrecoverable carrying costs are permanent operational expenses that build zero equity. Property taxes, specialized luxury estate insurance, and continuous elite security details drain cash endlessly. When building generational wealth, what is the single deadliest capital allocation error? A. Over-customizing a primary residence to the point of market rejection. B. Acquiring a secondary luxury development plot before liquidating the first. The fatal sequence error in this portfolio comes next. While floating the unsellable Palisades estate, the target made a massive misstep. The target deployed $12,500,000 in pure liquid capital. They used this to acquire a brand new residential plot in Brentwood. They did this before securing an exit on their primary asset. To clear the land, they completely destroyed the historic Zimmerman house. This was a historically significant mid-century architectural landmark. This destruction generated severe public relations friction. This created a suffocating cash trap. Simultaneously, the target family is temporarily occupying a rented Montecito estate owned by a prominent pop musician. Triple-layered capital leakage occurs across 3 separate geographic locations. This siphons operational cash flow away from yielding investments. One massive house is permanently stalled on the market. One active construction site is eating millions of dollars in rapid development costs. One third-party rental is enriching an outside landlord. This aggressively breaks the standard industry wealth model. Here is the intrinsic vulnerability of this massive portfolio. The target is betting their entire financial architecture on a highly dangerous assumption. They assume their active income engine will never stall. They are running on a treadmill that powers a furnace. Active physical labor creates the massive cash influx. The massive physical assets immediately burn that cash to the ground. A suffocating cash flow bottleneck forms instantly. If audience tastes shift or a prolonged industry strike hits, the active income drops instantly to zero. But the carrying costs on $30 million of illiquid dirt and concrete never sleep. The tax burden alone combined consumes hundreds of thousands of dollars annually. If the active influx stops for even a short period, the target will be forced into a distressed liquidation of the real estate assets. Will the relentless Southern California carrying costs trigger a distressed liquidation before the next studio contract is signed? Now we resolve the central mystery of the concrete anchor. The net worth appears massive on paper due to inflated real estate appraisals, but the leverage ratio is catastrophically low. Most of the acquired capital is entirely frozen. A staggering amount of wealth is anchored in unyielding residential assets. The ultimate goal of the standard model is very different. It is to build a baseline of passive yield that entirely covers the operational burn rate of the primary residence. This frees the massive active income to compound aggressively over time. A successful standard operator directs their post-tax cash into a diversified portfolio. They acquire commercial real estate holding stable leases. They invest in broad market indices. This standard strategy creates deep institutional safety. The target violently diverged from this proven path. They instead built a portfolio of hyper-customized residential concrete. This portfolio generates zero passive return. It represents a massive opportunity cost for their liquid capital. The long-term trajectory points sharply downward as heavy assets violently consume active cash. True wealth is not defined by how much active revenue you can generate through exhausting physical performance. It is defined by how long your yielding assets can sustain your life without your physical labor. To the members of the Capital Logic Network who support our channel and make this possible, thank you for everything.